All right, Chapter 9, Reporting and Analyzing Current Liabilities. In this chapter, we're going to look at current and long-term liabilities and describe their characteristics. We'll also look at contingent liabilities and some journal entries related to short-term notes payable, payroll deductions, and such, as well as warranties and bonuses. All right, so current and long-term liabilities and their characteristics. So defining a liability. So a liability is it comes about because a company has either owes something on a past transaction or event, or they have a present obligation, or for future payment of assets or services. Okay. So current liabilities due within a year, long-term liabilities due after 1 year. Okay, pretty simple. Um, so I'm not really sure what they're trying to tell us here. It's the same definitions, but other than when you look at your accounts payable, you can also do the same thing that we did when we looked at accounts receivable, and you can divide the amounts that are owed to your vendors by the total to figure out, what your largest vendor is per se, or what who you owe the most money to. So there's analytics and such like that would say, so in this case, Columbia Sportswear is 84% of their outstanding current liabilities, whereas Bull America is 58%, and so on. Okay. All right. So sometimes with liabilities, there's uncertainty about maybe who to pay, when to pay, how much to pay. And the answers to those questions are often indicative of when a liability is actually incurred and needs to be reported. So for example, if a company has $100 accounts payable to a specific individual that's payable on March 15th, the answer is pretty clear, right? You know who to pay, you know when to pay, how much to pay. However, the answer to one or more of these questions is uncertain for some liabilities, and we're going to talk about how to record those and when to record them. All right, so identifying and describing known current liabilities. All right, so known liabilities are things like accounts payable, sales tax payable, unearned revenues, short-term notes payable, payroll liabilities, multi-period known liabilities. Okay. So for instance, if Home Depot sold materials for $6,000 that are subject to a 5% tax, when they make that sale to the customer, they're going to record the sale, but they're also going to record a sales tax payable because the $6,300, which is the total of the sale plus the sales tax, isn't what they get to keep. So they're really just a pass-through for that payable piece, right? So they're collecting it from the customer and they're turning around and remitting it to the appropriate taxing authority. So when you make a sale subject to sales tax, you record a sales tax payable and you record your increase in cash for the sum total of both. Then when you pay the authority, you'll relieve your payable and reduce your cash. Okay? All right, so unearned revenues, also called deferred revenues, we've seen this before, but just as a reminder, on June 30th, let's say Rihanna sells $5 million in tickets for 8 concerts. Well, when she first makes that sale, it's all unearned ticket revenue because she hasn't performed any of the concerts. And then as she performs them, we reduce our unearned ticket revenue liability and we increase our revenue, right? So we looked at that a couple chapters ago, I believe. All right, entries for short-term notes payable. So short-term notes payable is basically a written promise to pay some specified amount on some future date within a year, or it wouldn't be short-term, right? Most of them bear interest and they can arise from overdue accounts payable or a borrowing from the bank. So like we were talking about notes receivable, with past due account receivables, taking them out of the account receivable and creating a note for our customers and charging interest. This is the same idea, it's just on the payable side. So it's you, the company, owing a vendor or a bank or some third party. So, for example, on August 23rd, if Brady Company asked McGraw to accept a $100 cash 60-day 12% note to replace its existing $600 account payable, here's what happens. So, if we had an account payable on our books for $600, we would reduce that and we would do that with a debit. So you have that debit to accounts payable for $600. We're going to pay them cash of 100, so we reduce our cash by 100, and then we record our $500 note payable, increased note payables with credits, right? Then on October 22nd, when Brady pays the note, we're going to reduce our notes payable with $500 debit. We're going to record the interest expense that we had to pay on that note. So that's similar to the notes receivable, your $500 times your 12% times 60 out of 360 for your total interest of $10 on the 60-day note. So we'll record interest expense for $10 and we'll record cash out the door reduction, credit of $510. Okay. Then note given to a borrower from a bank. So on September 30th, the company borrows $2,000 from a bank at 12% interest for 60 days. So when we do that, we're going to increase our cash for $2,000 with a debit, and we're going to increase our note payable $2,000 credit. Okay. Then 60 days later, when we pay it on November 29th, we're going to reduce our note payable. We do that with a credit or a debit, sorry. Let me find my handy dandy pencil here. That's that first one. And then we're going to record our interest expense, which is our $2,000 times 12% times 60 divided by 360. We're going to reduce our cash for the total of the two, which is our credit here of $2,040. Okay. All right, so when the end of the counting period occurs between the signing of the note payable and its maturity date, we have to record the accrued but the unpaid interest on the note. So let's say our note date is, somewhere here before the end of the period, but our maturity date's over here. My arrow is going the wrong direction. Holy moly. It's been a long week. It's Friday night here, folks. It's hard to record this stuff at the end of a week. All right, so I don't have anything better to do on a Friday night, It's awesome. That's what happens when you're old. I digress. So when a note extends over period end, you have to make an adjusting entry to record the interest expense incurred year to date. Okay. So on December 16th, 2018, the company borrows a $2,000 from the bank at a 12% interest for 60 days. So on the 16th, they borrowed it. Here we are at December 31st, the end of the period. So how many days have passed since then? Right? 31 minus 14 days, or minus 31 minus 15 days, or 16 days, whatever that math works out to be. It's 15 days of interest. So you need to accrue your interest expense at the end of the year. So you take your 2,000 times 12% times 15 days out of 360. You're going to record a debit to interest expense and a credit to interest payable. Then on February 14th, when you repay the principal and interest, you're going to reduce your interest payable. That's this guy right here. You're going to record the additional interest expense for the remaining 45 days of your 60. You had total 60. You recorded 15 worth here. You have 45 in the next year. So you take your 2,000 times 12% times 45 divided by 360. That's how you get this 30. And that goes straight to expense in the year it's paid, right? And then you reduce your note payable with a debit of $2,000 and you record your cash out the door, $2,040 as a credit, which reduces cash. All right, let's work through an example here and see if some of this doesn't make some sense. So a retailer sells merchandise for $500 cash on June 30, cost of $300. Sales tax law requires the retailer to collect 7% on every dollar. So record the entry for the $500 sale and its applicable sales tax. And then also record the entry that shows the remittance of it to the government on July 15th. So on June 30th, we're going to record our sale for $500. $500 times 7% is $35. So we're going to credit sales and credit sales tax payable for $535 respectively. And you have cash coming in the door, total of 2, debit of $535. Then you also have to record the cost, right? Every time you make a sale of inventory or merchandise, you have to also record the cost of that merchandise. So we're going to record cost of goods sold of $300, debit. We're going to reduce our merchandise inventory with a credit of $300. Then on July 15th, when we pay it to the government, we're going to reduce our sales tax payable, $35 debit. We're going to reduce our cash, $35. Okay? All right, a ticket agency receives $40,000 cash in advance ticket sales for a 4-day tour of, I don't know who this is, D-Bit and the A Crew. That's going to be our band name, okay? All right, record the advance ticket sales on April 30th. Record the revenue earned for the first concert date as of May 15th, assuming it represents 1/4 of the ticket sales. So when we receive it in advance, we're going to increase our cash and we're going to increase our unearned ticket revenue, right? The debit of 40 and a credit to unearned ticket revenue of 40. Then on May 15th, when they perform one of the concerts, we're going to record $10,000 revenue, right? 1/4 of the advanced ticket sales of D-Bit and the A Crew. So we're going to earn that revenue. So we're going to reduce our unearned ticket revenue by $10,000 with the debit. And we're going to earn ticket revenue, $10,000 credit. Okay? All right, then part 3, on November 25th of the current year, company borrows $8,000 cash by signing a 90-day 5% note payable with a face value of $8,000. Compute the accrued interest payable on December 31st. Prepare the journal entry and to record the interest expense at December 31st and the journal entry to record the payment at maturity. So, all right, $8,000 times 90 days times 5% times 90 divided by 360 times 5% is what? Oh, wait, let me back up. When we first take out the note, debit cash, credit note payable, right? Then our interest expense for 36 days between November 25th and December 31st. Take 8,000 times 5% times 36 divided by 360. $40 debit to interest expense and a $40 credit to interest payable. Okay. Then on February 23rd, when we record the payment of the note, we're going to reduce our interest payable that we recorded here, right? That's this going away there. We record our interest expense for the other 54 days of our 90. The debit to interest expense of $60. We're going to remove our note payable from the book. We do that. We had a credit here, right? So we do that with a debit here. And we record total cash out the door of $8,100. All right, so computing and recording employee payroll deductions and liabilities. Important to know because the government takes all of your money. All right. So, payroll liabilities. What is a payroll liability? A payroll liability is expenses that an employer incurs from having employees, right? Believe it or not, it costs employers more money than just your salary to have you on staff. All right, so here's how this works. So gross pay is the total compensation an employee earns, including wages, salary, commission, bonus, and any other compensation earned before deductions such as taxes. So let's see, what are we trying to show here? So you have gross pay right up here. I lost my pen. Right up here. Then you've got federal income tax, state and local tax, voluntary deductions, FICA tax, which is basically Medicare and Social Security, and then, you know, after the government takes all of their pieces, here's what you get to take home. Okay? All right. So employers are required to withhold federal insurance contributions, act taxes, FICA, FICA for short, from an employee's pay. So they're basically separated into two groups. You got Social Security, which is, you know, withholdings to cover retirement, disability, and survivorship. That hopefully will be there when we all retire, but you never know. And then you have Medicare taxes, which are withholdings to cover medical benefits that also don't really help you all that much, so I've heard. Okay, so that's the deal on FICA. Then we've got employee income tax. So most employers are required to withhold federal income tax from each employee's paycheck. So the amount withheld is basically computed using tables published by the IRS. So the amount depends on the employee's income and the number of withholding allowances that you claim as the employee, right? So we have to withhold those taxes from employee paychecks, and then we submit them to the appropriate government agency. All right, so then you also have this section called employee voluntary deductions. So this is things like union dues, savings accounts, pension contributions, 401k contributions, insurance premiums, and any charitable contributions, right? So those are basically up to the employee to have withheld or not have withheld, okay? All right, so the way we record payroll. So an entry to record payroll might look like this. So you have your salary expense for the entire gross wages, let's say. So say an employee earns a salary of $2,000 per month. So at the end of January, when we record that payroll, we're going to record the salary expense just like any other expense with debit. But then all that money you withheld from their paycheck, you got to pay people, right? The appropriate governing authorities. And so you're going to have a FICA tax payable for the Social Security piece. You're going to have a FICA tax payable for the Medicare piece. You're going to have a federal income tax payable for the just regular federal income taxes, right? You're going to have a medical insurance payable maybe that you're going to turn around and remit to the insurance company. You're going to have maybe a dues payable you're going to turn around and remit to the union. And then ultimately you have the net, which is your salaries payable. Okay, that's what the employee ends up getting. Then when you pay that employee, when the paycheck's actually cut, you're going to debit your salaries payable and credit cash. Okay? All right, so computing and recording employer payroll deductions. So what we just talked about was employee. So those are all the pieces that the employee owes that you as the employer are really just a conduit where you're withholding it, but then you're just turning around and remitting it to the appropriate authorities. Okay. So on this side, we're going to talk about the employer payroll taxes. So the employer pays amounts equal to that which is withheld on the employee's pay for FICA and Social Security. Okay. And then other tax called federal and state unemployment taxes. So federal unemployment taxes, I don't know if these rates are still good or not. I don't know what year they pertain to. They look somewhat familiar, but I'm not sure if they've been updated for 18 or not. So let's pretend they are. So the federal government works with the states in a joint federal and state unemployment insurance program. And each state administers its program, so they provide unemployment benefits to qualified workers. Well, how they do that is that employers pay into that fund, right? So on the employer side only, the employer owes federal and state unemployment taxes that are based on these calcs. So it's 6% of the first $7,000 of wages paid to each employee, and then for federal, and then a credit of up to 5.4% is given for the SUTA paid. So the net rate's basically 0.6. And then state unemployment is 5.4% of the first $7,000 of wages paid to each employee. So that's the scoop with the unemployment taxes. All right, so on the employer side, when we're recording an entry for payroll, it might look something like this. So you have payroll tax expense, debit, and then you have your credit for all the employer owed payables related to payroll. So you're going to have an employer owed piece for Social Security and Medicare that you're going to record to a taxes payable account. Those are the exact same credits as what you book on the employee side. Same account too, by the way. And then you have state unemployment and a federal unemployment, SUTA and FUTA, taxes payable accounts for the pieces that are just on the employer side, where you're basically every time you run payroll, you have a liability and then you remit it every so often. Okay. All right, so internal control and payroll. So there's 4 areas of payroll activities that should be separated and monitored. Employee hiring, payroll prep, timekeeping, and payroll payment. You shouldn't have the same person doing those things. Okay. Many known liabilities extend over multiple periods. So think about unearned revenues or notes payable. And so, what do I want to say here? So, the question is, when they cover multiple periods, are they supposed to be a current liability or are they a long-term liability? Well, the answer is they're both. What happens is the portion of in the case of like the unearned revenues from magazine subscriptions, I mean, a portion of the unearned revenue is recognized for each period, and then the unearned revenue account is reduced, right? And then under notes payable, what happens is if you have a 3-year note, the amounts that are due within the next year are classified as current, and everything else is classified as long-term. Okay. So let's look at an example. So the company's first weekly pay period of the year ends on January 8th. On that date, the column totals in its payroll register show that the employees earns $30,000. Office employees earn $20,000, and they have all these taxes withheld from their paychecks. And so what they want us to do first is to compute the FICA Social Security tax payable and then FICA Medicare tax payable and prepare that entry. So the key sentence here is that no employee earned more than $7,000 in the first pay period. So what that means is you can take the $30,000 plus the $20,000 times those rates to compute the payables. So if you take your FICA Social Security tax payable and right here, $50,000, that's the sum of the 30 and the 20, times 0.62%, they give you that in the problem. You're going to record a FICA tax payable of $3,100. And then your Medicare, same thing, 50 times 1.45. They give you that rate up here, right? So you're going to record a FICA Medicare tax payable of $725. You're going to record federal income tax payable of $9,000. They give you that number. You're going to record employee medical insurance payable of $2,000. And you're going to record a $1,000 pension payable. They give you that number in the problem up above too. You have your expense. They tell you you've got sales salaries of 30, and you have office salaries of 20,000. So those would be your debits to expense for the gross wages. Then you credit all your payables, and then your net payable to your employees is the 34,175. It's the difference between your debits and your credits. Okay? Then in part 2, prepare the journal entry to record the company's employer taxes resulting from the January 8th payroll. So its merit uses a state unemployment rate of 3.4, the first 7,000 paid each employee, and the federal is 0.6. So again, if you take the 3.4 times $50,000 and the 0.6 times $50,000, you're going to record state unemployment of $1,700 payable and federal unemployment of $300. The same thing with FICA and Medicare. You're going to use those same rates from the last example. So you're going to record the exact same pieces of the journal entry as you did up here. You're going to record those on the employer side too. So you have the 4 payables, your FICA Social Security, FICA Medicare, your SUTA and your FUTA, all to payables. And then your offsetting debit is payroll tax expense. Okay? All right, so accounting for estimated liabilities, warranties, and bonuses. All right, so an estimated liability is a known obligation of an uncertain amount that can be reasonably estimated. Okay, so common examples of these would be like employee benefits, such as pensions, healthcare, vacation pay, and warranties that are offered by a seller. Oh, there's your examples. All right, so health and pension benefits. So an employer expenses for employer expenses for pension or for medical, dental, life, disability insurance. So assume an employer agrees to pay an amount for medical insurance equal to $8,000 and contribute an additional 10% of the employee's $120,000 gross salary to a retirement program. So you're going to have employee benefits expense of $20,000, which is the $8,000 plus 10% of the $120,000. Then you're going to have an employee medical insurance payable of $8,000, and you're going to have an employee retirement program payable of $12,000. Okay. All right, so vacation benefits. So if we assume an employee earns $20,800 per year and gets 2 weeks of vacation each year, here's how you figure out the vacation benefit. $20,800 divided by 50 weeks, because that's how many weeks they're actually earning or actually working, because 2 weeks is vacation, is $416. $20,800 divided by 52 weeks is $400. And so the weekly vacation benefit is 16 bucks. So you're going to record vacation benefit expense with a debit of 16 and a vacation benefits payable with a credit of 16. So when an employee takes a vacation, the following journal entry is recorded. Vacation benefits payable, reduction of $416,000, or $416, excuse me. And you're going to record cash out the door of $416. The reason why you do that is because we said that 1 week's worth of vacation time is 416 bucks. Okay? All right, bonus plans. So assume a bonus of $10,000 will be paid to all employees to be employees to be shared by all. You record employee bonus expense, debit of $10,000, and you credit bonus payable. Okay? All right, so warranty liabilities. So a warranty is a seller's obligation to fix or replace a product or service that fails to perform as expected within a specified period. So think new cars. They typically come with warranties maybe for a period of time, and inevitably when the warranty wears out, then something breaks on the car, right? That's how it works. So the company makes the money, you bought the warranty, and you never got to use it because it expires, before your problem starts to happen. Anyway, so when sellers do that, they have to report some kind of expected warranty expense in the same period in which the revenue from the sales reported. And so the way we do that is we record like a warranty obligation or a warranty liability. And we'll go through an example, I think, here on the next slide. All right, so on December 1st, dealer sells a car for $16,000 with a 1-year, 12,000-mile warranty covering parts. Past experience indicates that warranty expenses average 4% of the car's selling price. So when you sell that car, you're also going to record an estimated warranty liability and related warranty expense. So 4% of $16,000 is 640 bucks. So you're going to record an estimated warranty liability with a credit of $640, and you're going to debit warranty expense for $640. Then when the customer says, "Hey, yo, my car needs fixed," you're going to reduce your warranty liability for whatever the cost of it is. In this case, they're telling us it's $200. And then you're going to reduce your auto parts inventory for whatever parts you had to use to fix the car. Okay? All right, so a company's salaried employees earn 2 weeks of vacation per year, pays $208,000 in total employee salaries for 52 weeks, but employees only work 50. So that means the total weekly salary expense is $4,160, which is our $208,000 divided by 50 weeks, instead of $4,000, which is our 208 divided by 52 weeks. So record the company's regular weekly vacation benefit expense. All right, so we have vacation benefit expense, difference between the two, 160 bucks, and vacation benefits payable, credit of 160 bucks. So expense recognition principle, expense is recognized in the same period as the revenue that it helped generate. All right, so for the current year, ended December 31st, the company has implemented an employee bonus program based on its net income, which employees will share equally. Its bonus expense is $40,000. So prepare the journal entry December 31st to record the bonus due, and then the journal entry December 20th to record the payment of that bonus expense. So the journal entry December 31st is a debit to employee bonus expense for $40,000, and a credit to bonus payable, right? Then on the 20th, when we pay it, we debit our bonus payable and we credit our cash, right? Again, expenses recognized in the same period as the revenue it helped generate. So on June 11th, the retailer sells a trimmer with $400 with a 1-year warranty that covers parts. Warranty expense is estimated to be 5% of sales. On March 24th of the next year, the trimmer is brought in for repairs covered under the warranty, requiring $15 in materials taken from the repair parts inventory. So prepare the entry A to record the sale, and then B to record the warranty repairs. So on June 11th, we're going to record cash for $400 with a debit, and we're going to record our sale. We also, on June 11th, have to record our estimated warranty liability, which they say is 5% on average. So we're going to take $400 times 5% for warranty expense, debit at 20. Then we're going to credit our estimated warranty liability for 20. Then on the 24th, when they repair the trimmer, we're going to reduce our warranty liability because we had already recognized that expense, right? So we're just reducing the liability because we performed the services that are covered under warranty. So we do that with a debit for 15, and we reduce our repair parts inventory for $15. Okay? All right, how to account for contingent liabilities. All right, so contingent liability is a potential obligation that depends on a future event arising from a past transaction or event. So an example here would be like a pending lawsuit. So here, a past transaction or event leads to a lawsuit whose result depends on the outcome of the suit. So future payment of a contingent liability depends on whether or not the uncertain event is going to occur. So what this chart is telling you is that if the future event is probable and what happened to my pen? Is probable, and the amount owed is estimable, you have to record it. Actually book a debit or credit in a debit and a credit in your accounting ledger, right? But if it's probable and you can't estimate it, you just have to disclose it in the notes. Those are all the words behind the pages with the numbers on them. That's what we call the footnotes. All right. If it's possible, you disclose it in the notes. If it's remote, no disclosure. Okay. So, if the future event is reasonably possible, could occur, we disclose this information in the notes to the financial statements. So, two common examples are pending legal claims from lawsuits and when a company guarantees debt. So, usually the guarantor discloses the guarantee in its financial statement notes. If it is probable the debtor will default, then the guarantor actually reports the guarantee as a liability. Okay? Then there's some other contingencies that include like environmental damages, tax assessments, insurance losses, government investigations, those kinds of things. Okay? All right, and then there's uncertainties, which is uncertainties from future events are not contingent liabilities because they are future events and do not arise from past transactions. So the key here is in order to be a contingent liability, it has to arise from a past transaction. Okay? All right, so the following legal claims exist for a company. Identify the accounting treatment for each claim as either a liability that has to be recorded or an item that is disclosed in the financial statements. If it needs to be recorded, prepare the entry. So in A, the company defendant estimates that a pending lawsuit could result in damages of $500,000, and it is reasonably possible the plaintiff will win the case. So in A, oh, I didn't know I was going to give all the answers at once. Well, there you go. So if it is reasonably estimated, but it's not probable, they say it's possible. You don't have to record it, because to be recorded, it must be both probable and reasonably estimable. Estimable. In B, the company faces a probable loss. So in order to be recorded, it has to be probable. And, oh, it's not reasonably estimable. So in number 2, probable loss but can't be reasonably estimated, you don't have a contingent liability. Then in letter C, the company estimates environmental damages in a pending case of $900,000 with a high probability of losing. That's a contingent liability. So you would record environmental contingent expense of $900,000, and you would record an environmental contingent liability with credit of $900,000. Okay? All right, so compute the times interest earned ratio. All right, so interest expense is typically viewed as a fixed expense because it seldom varies as a result of short-term changes in sales or other operating activities, because it's usually primarily based upon long-term debt, right? So while fixed expenses can be advantageous when a company is growing, meaning your expenses aren't growing at the same rate as your revenue, right? So it generates more income in theory. Let me draw a picture of what I mean, what I just said there. If your revenue is going like this when the company's growing and your expenses just stay like this, that means more net income for you. Yay, right? So, but the risk that fixed expense presents is that if revenues are going like this, oops, not so much net income for you, right? So there's this times interest earned ratio that basically takes income before interest and tax and divides it by total interest expense. And so if income before interest and tax varies greatly from year to year, fixed interest charges can increase the risk that an owner will not earn a positive return and they will be unable to pay their interest charges. Okay. So if we look at Diego Co.'s results for 2018, looks like their times interest earned calc, basically their income before interest and tax divided by their interest expense is 2.5 times. So they're earning 2.5 times their income, or they're earning 2.5 times more in income than what their fixed interest expense is. So, yeah, I think that's about all I have to say there. All right, so I am not going to go through Appendix 9A. If you want to be an overachiever and look through that, feel free, but it is, I don't believe anything from Appendix 9A is going to be on the exam. So we will stop there with Chapter 9. And as always, if you have any questions, please don't hesitate to reach out. Thanks, guys.